Today, a new report highlights mismanagement at FTX. Arkansas joins Montana and passes a bill protecting Bitcoin miners. And Jeff Dorman of crypto investment firm Arca breaks down what to expect from this week's Shanghai upgrade. Welcome to CNBC's Crypto World. I'm Pippa Stevens. Major cryptocurrencies are in the green to start the week. As of noon Eastern, Bitcoin jumped above the $28,000 level, and Ether was above the $1,800 mark. Solana was trading right around 20 bucks. Okay, let's talk about the top stories. First up, a new report from the current management of FTX says that hubris, incompetence, and greed led to the demise of the crypto exchange. This report was based on the new management's review of terabytes of electronic data and communications, more than 1 million documents, and interviews conducted with 19 former employees. Revelations from the report include that FTX lacked any internal audit function and that the firm failed to put in place basic, widely accepted security controls to protect crypto assets. The report also says that the former U.S. president of the crypto exchange resigned partly due to a, quote, protracted disagreement with former CEO Sam Bankman-Fried and members of his inner circle. The ex-FTX U.S. president, that's Brett Harrison, had serious doubts about how the exchange was being run, and when he expressed his concerns to SBF, his bonus was drastically reduced, and he was told by company lawyers to apologize to him, but he refused. These allegations are consistent with his statements on Twitter from January, in which Harrison explained how he was approached to join FTX and what his experience was like at the firm. In one tweet, he wrote that his relationship with SBF and his deputies had reached a point of total deterioration after months of disputes over management practices. Next, a bill looking to regulate Bitcoin mining activity in Arkansas has passed in the state's House and Senate. The Arkansas Data Centers Act intends to clarify guidelines for miners and offer protections from discriminatory regulations and taxes. Under the legislation, crypto miners will have the same rights as data centers, and the bill recognizes that data centers create jobs and provide economic value to local communities. It requires digital miners to pay applicable taxes and government fees in acceptable forms of currency. They also must operate in a way that causes no stress on an electric public utilities generation capabilities or transmission network. Now, this development in Arkansas follows a similar initiative in Montana. But at the same time, CoinDesk reports a proposed new law in Texas, which could restrict key benefits for Bitcoin miners, passed a state Senate committee last week. Texas has been a major hub for Bitcoin miners. Last, Binance US is struggling to find a bank to handle its customers' cash after last month's closure of Signature Bank. That's according to the Wall Street Journal, which cited people familiar with the situation. The journal reports that dollar deposits in the U.S. used to be sent to either Signature or Silvergate. Over the weekend, the newspaper reported that the exchange is using at least one intermediary to store funds, and that since the money is being held by a third party, the process of sending and moving funds can be slowed down. Binance US reportedly tried to establish relationships with banks like customers, but banks have been hesitant due to concerns over regulatory risk. Customers Bank declined to comment to us. We also reached out to Binance US about the Wall Street Journal article, but did not immediately hear back. However, the newspaper reported that a spokesperson said that the exchange works with multiple US-based banking and payment providers and continues to onboard new partners while upgrading its internal systems to create a more stable fiat platform and offer additional services. All right, for our main story, let's talk more about markets. Amid the backdrop of crypto-friendly banks shuttering and the next big update for Ethereum expected in just days, Crypto World's Talia Kaplan spoke with the chief investment officer of crypto investment firm Arca for insight into what's driving prices and what's expected from the Shanghai upgrade.
I want to start off by asking, what do you think is driving markets right now? I mean, you recently wrote an op-ed arguing that macro conditions are now moving digital asset markets once again. You say that for the past 9 months, most of the price action was driven by failures like the FTX collapse, as well as success stories like the Ethereum merge, and that overall macro conditions have taken a backseat. But over the past few weeks, that all has changed. You also write that the banking crisis and the policy response are impacting digital assets positively at the expense of other asset classes. Can you elaborate?
Yeah, absolutely. So, one of the things we talked about in November and December was you had a pretty perfect storm against digital assets, culminating with the FTX, fraud and ultimately bankruptcy. It looked towards the end of December that we had seen the bottom, right? There was a lot of capitulation, a lot of people leaving the market. What we didn't know was when would there be any sort of a positive catalyst, right? So sometimes it's easy to find when all the selling is done, but that doesn't make markets go higher. What makes markets go higher is when you actually have real buying. And that was the lack of catalyst that couldn't identify even in the January rally, was what was actually going to take us higher. And then ultimately we had the banking crisis of early March, which really provided that positive catalyst. And what I mean by that is historically digital assets were just one of many things you could own, right? And it was never really viewed as something that you would think of as being a safe asset to own, right? It was a volatile asset. It potentially had high returns and certainly had different properties and attributes that could generate positive returns or negative returns. But safety wasn't really one that generally people thought of. What happened after the first week of March, when you started to have the banking issues, right? Starting initially with Signature Bank and Silvergate, and then ultimately into Silicon Valley Bank, and then across the pond over with Credit Suisse and others, was all of a sudden everybody, and not just crypto people, but everybody, small business owners, high net worth individuals, et cetera, had to start reevaluating what does it mean to have a safe asset, right? Historically, your money in the bank would be viewed as a safe asset. After the weeks of March 7th to the 14th, that wasn't really the case anymore. So as you start reevaluating what is safe, you have to start reprioritizing. And I think what you started to see was a real rotation, right? There was 30-some billion dollars that left Signature, Silvergate, and Silicon Valley Bank that had to find its way either into brokerage accounts, into too big to fail banks, or into Bitcoin and Ethereum. You also had almost 20 billion leave stablecoins. Well, again, that money had to go somewhere. And I think even if only a fraction of that 45 to $50 billion went into Bitcoin and Ethereum, that was enough to drive prices. And we're still seeing it today.
So right now, there's this backdrop of all this crypto-related news. You brought up the closure of crypto-focused banks, Silvergate and Signature, as well as the continuous regulatory crackdown with the CFTC's lawsuit against Binance, and Coinbase revealing that the SEC sent the exchange a Wells notice, which is typically the last step before an enforcement action. So with all this going on, what is your outlook for crypto?
Well, this is where it gets really interesting, because if you look across all markets right now, you're definitely starting to see a recessionary playbook. What I mean by that is typically macro investors, when they think a recession is coming, you start to see exactly what we're seeing in the markets today, which is front-end rates start to drop sharply because it indicates that they think the Fed and other central banks will reverse course and start to lower rates again. You start to see gold going higher, and of course, gold has been on a tear this first quarter of the year and is approaching all-time highs. You start to see commodities like oil go down, which is what we're seeing. And you see small caps and growth stocks start to underperform large caps and values. Basically, you have defensives, outperforming cyclicals. And then you have technology, which is sort of a mixed bag. Sometimes technology benefits from lower rates. Sometimes it suffers because of lower consumption with recession. So we can't really say historically what assets like Bitcoin and ETH and other digital assets will do in a recession, because quite frankly, we haven't had a recession since Bitcoin and ETH and other digital assets have been created. We've seen hints of recessions, right? We saw it briefly in 2015, but that went away after like a month, and the central banks acted again to put a lot of money into the system. We saw it again in 2018, but then they broke 2019, but then they broke the repo market and had to fix everything again with more money. You saw it again in 2020 with COVID, but they fixed that in a month. So we've never actually seen how digital assets would perform in a recessionary environment. And it could go both ways, right? They could start to behave like riskier stocks and just sell off along with other things. Or you might start to be a little more analytical about it and say, well, actually, most digital asset companies and projects, they have no physical rent to pay. They have very few employees to pay. They don't have cost of goods. They don't have any of the things that traditionally suffer when you have consumer spending going lower. And also, because you can't actually go bankrupt, right? These protocols have proven over and over again that they're not like stocks, right? Stocks like FTX go to zero. Stocks like BlockFi go to zero. Stocks like Signature and Silvergate go to zero because they go into a bankruptcy and there's a court process and there's a restructuring where your equity gets primed by debt and other creditors that are ahead of you. Well, in the protocol world, these are basically just long tail options that never really go away. And that's a pretty good place to hide out during a recession when there's no risk of actual cash flow declines and bankruptcy. So the jury is still out. I personally think that digital assets will actually hold up pretty well in a recessionary environment. For all the reasons we just mentioned, right? The lack of faith in governments and banks, combined with the fact that these are relatively safe assets when you have cash flows decline and consumer spending going down.
So we brought up the merge earlier, but Ethereum's next big upgrade, Shanghai, is right around the corner, and the update will finally allow users to withdraw Ether that has been staked since December 2020. What do you expect to happen? Do you think once this Ether becomes unlocked this month, there will be a massive sell-off perhaps?
I think you might have a very brief sell-off, more based on narrative than actual flows. Only about 15 or 14% of ETH is currently staked. And there's a reason for that, right? It's because most people prefer liquidity over yield. There's a cohort of investors and people who are like, I don't need my money right away. I'd rather, lock it up and get a higher yield. But for the most part, people favor liquidity. And there's a rule of thumb with investing and really holding assets in general, which is you always want your assets to be productive when they can. So if you own a lot of Ethereum right now, whether you're a fund or you're a corporate treasury or whatever, and you have a chance to earn yield, but being able to do it where you can move your money in and out seamlessly without any friction, without any delays, without any lockups, that's a much more appealing option. So what I'm getting at is that while some of that 14% of ETH that is currently staked might become unstaked and sold, the other 86% of ETH holders who are currently not staking are much more likely to stake, even if it's just for a day or a half a day, because you can earn that yield on a short-term basis and still get your assets back. So I think it's going to be very short-lived if there is any selling pressure on ETH at all. And I think ultimately it's going to lead to a much higher staking rate, which not only benefits Ethereum, but obviously benefits liquid staking providers like Lido and Rocket Pool and some others, Frax.
Okay, that's all for Crypto World today, but we are back again tomorrow and we will see you then.